studying your last two. I swim med tea when they turned in. The staring down to mute. And can learn the pole that sunk he died.
Schedule 100 is the GIFI balance sheet that accompanies the T2 corporate income tax return. Its purpose is to report a corporation's financial position in the standardized format required by the Canada Revenue Agency. Instead of submitting a balance sheet in whatever format the corporation's accounting software produces, the financial information is organized using the GIFI reporting structure. The process begins with the corporation's own balance sheet. This balance sheet is prepared from the accounting records and includes the three fundamental sections of every balance sheet: assets, liabilities, and shareholders' equity. At this stage, the corporation is still using its own chart of accounts and account names. The next step is to convert that balance sheet into Schedule 100. During this conversion, each balance sheet account is assigned to the appropriate GIFI category. Whether the corporation uses QuickBooks, Sage, Excel, or another accounting system, the financial information is translated into the standardized GIFI format expected by the CRA. Once the information has been organized into Schedule 100, it becomes part of the corporation's electronic T2 filing. Because every corporation reports its balance sheet using the same standardized GIFI categories, the CRA can process, analyze, and compare financial information much more efficiently. It's important to understand that Schedule 100 does not replace the corporation's balance sheet. The corporation continues to prepare its financial statements using normal accounting principles. Schedule 100 simply converts that information into a common reporting format so that every corporation in Canada reports its financial position in a consistent way. The key takeaway is that Schedule 100 is the bridge between a corporation's accounting balance sheet and the CRA's reporting system. It transforms the company's financial position into the standardized GIFI format, making electronic filing more efficient, improving consistency, and allowing the CRA to process corporate tax returns accurately. Every balance sheet, regardless of the size of the business or the accounting software being used, is built around one fundamental accounting equation: assets equal liabilities plus shareholders' equity. Schedule 100 follows this same structure by organizing every balance sheet account into one of these three major categories. The first section is assets. Assets are the economic resources owned or controlled by the corporation that are expected to provide future benefits. Common examples include cash, accounts receivable, inventory, buildings, vehicles, equipment, and other business property. These are the resources the corporation uses to operate and generate income. The second section is liabilities. Liabilities represent amounts that the corporation owes to other parties. These obligations may include bank loans, mortgages, accounts payable, credit card balances, taxes payable, and other debts. In simple terms, liabilities represent the corporation's financial obligations that must eventually be repaid. The third section is shareholders' equity. Equity represents the owner's interest in the corporation after all liabilities have been deducted from the assets. It includes items such as share capital contributed by shareholders, retained earnings accumulated from past profits, and other equity accounts that reflect the owner's investment in the business. One of the most important principles in accounting is that these three sections are always connected through the accounting equation. The total value of the corporation's assets must always equal the total of its liabilities, plus shareholders' equity. This equation ensures that the balance sheet remains balanced and accurately reflects the corporation's financial position. When preparing Schedule 100, every balance sheet account is assigned to one of these three categories. Whether it's cash, inventory, a bank loan, or retained earnings. Each account belongs under assets, liabilities, or shareholders' equity using the appropriate GIFI category. The key takeaway is that Schedule 100 doesn't introduce a new accounting concept, it simply organizes a corporation's balance sheet into the standardized GIFI format, while preserving the fundamental accounting equation. Understanding these three major sections makes it much easier to understand how financial information is reported on the T2 corporate income tax return. Every corporation maintains its own chart of accounts. Depending on the accounting software or bookkeeping practices used, businesses may organize and name their accounts differently. For example, one company may use an account called cash, another may call it bank account, and another may simply use checking. Although the names differ, they all represent the same type of financial information. When preparing Schedule 100, these individual accounting accounts are mapped into standardized GIFI categories. This mapping process is what allows corporations with completely different accounting systems to report their financial position in a consistent format accepted by the Canada Revenue Agency. The process begins with the corporation's accounting software or general ledger, where all balance sheet accounts are recorded. These accounts include items such as cash, accounts receivable, inventory, equipment, accounts payable, bank loans, share capital, and retained earnings. Next, each account is matched to its appropriate GIFI category. Cash is mapped to the GIFI category for cash. Inventory is mapped to the inventory category. Equipment is reported under capital assets. Bank loans are classified as long-term debt when appropriate, and retained earnings are reported under shareholders' equity. The objective is not to change the financial information, but simply to organize it according to the standardized GIFI reporting structure. Once every balance sheet account has been mapped, the information is assembled into Schedule 100. The completed schedule presents the corporation's assets, liabilities, and shareholders' equity in the consistent format required for electronic filing with the T2 corporate income tax return. It's important to understand that Schedule 100 does not replace the corporation's accounting records or financial statements. The accounting system continues to use the company's own chart of accounts, while Schedule 100 simply translates those accounts into standardized GIFI categories for tax reporting. The key takeaway is that Schedule 100 serves as a bridge between a corporation's internal accounting system and the CRA's reporting requirements. Regardless of the accounting software or account names used by the business, every balance sheet account is mapped into a common GIFI structure, ensuring consistent reporting, efficient electronic filing, and accurate processing by the Canada Revenue Agency.